has been. Okay, all right. That was on the larger scale of things. Now I have two trade ideas with me this time. Both of them are bullish, and both of them are the type of stocks that we have not covered previously extensively. So you're not going to find a lot of literature on this. If you try to look in the activity tracker, or if you try to dig through the weekend research and whatnot. Okay, and so let's dive into them, and I'll present you exactly what those trade ideas. All right. The first one is I'd like you to buy call options in Athenaheath, ATHN, Athenaheath. I'm expecting a breakout from this soon. This is heavy volume of price resistance. It's consolidating beautifully over here after a big gap higher after last earnings report. And I'm expecting a breakout from this pretty soon. And I think it's going to run to 150 to 160. But the earnings are already out of the way, and I want to give it a little bit more time than normal, okay? Because we have to see the catalyst or the fundamental bull case play out, because we don't have a short-term catalyst earnings in play at this time. So I would like to go out to June in this particular case, and the trade is to buy a vertical spread. It's going to be expensive. You can go with straight calls if you like, that would be fine too, but reduce your cost. And what I would like to do is buy June 145, 165 vertical spread, and I think you can buy that for about $6.50 or less. Okay, so by June 145, 165 vertical spread, call spread for $6.50 or less. And if you want to go with just a straight calls, June 41, 45 call, that is perfectly fine as well. All right, but I think this is spread, because it's a $6.50 spread for this $6.50 cost for this for a $20 wide spread. And I think that's a little bit over 3-to-1 risk or reward, and with a net delta of 0.26, just slightly below my 0.30 threshold, and I think it looks very attractive. On top of it, there are 100 days to June expiration, and I think that is sufficient to see at least one more earnings report, as well as any other thing that will come across during this time. So 100 days is pretty good time. Implied volatility has settled back in the mid 30s. Usually it tends to jump up to 45 to 50% before earnings. So that's another key reason why I like positioning now. And then the last thing is the stock, the technicals. It is setting up for a beautiful breakout right here. So the company reported earnings over here, very high volume, sharp attempt to break out. But then since then, remember this rally happened on February 2nd. It's important to point that out. On February 2nd, this stock was ripping higher, was up huge, and it was trying to break out. But that day, on February 2nd, Dow index was down 1,000 points. Okay, so obviously there were natural market forces that were going against anything that was trying to run at that particular time. And so the company didn't have the firepower, the stock didn't have the firepower to break out. And since then, we saw more and more selling since then. Okay, but it filled the gap. It immediately pulled back because of the market. There was another big 1,000 point sell-off day in the market, and more so, and it finally filled the gap. It ripped higher, and now it's consolidating in this tight range with 145. Let's put a line over here so you can see. Right over here. Let's put a line over here, and you can see that this is the major volume of price resistance. It's about 143 round. So we're at 141.38. It's not far off. It's only about $1.60 or something. This is not an earnings play. So if you do not like doing earnings plays, you can comfortably go in this trade, because these are June call options as well. And you don't have to try to position in this unnecessarily by going too low either. I mean, I'm talking about position sizing over here. Sometimes in these webinars, we bring strictly earnings plays, and I always mention that go with lunch money. In this case, you don't have to go with lunch money. You could go with your normal size of the trade that you go in the call options. I'm looking for a breakout through this 143, and I think it's going to open the door for an impressive rally. It could happen anytime, because this is a beautiful bull flag formation, and I think you're going to see a breakout in this, and you're going to see this run higher swiftly, potentially all the way to 155 or 160 level, and basically go to new 52-week high. On the long-term weekly scale, you can see this how far back this resistance goes. All right, so let's put it right here. So you can see this is quite a bit long. This goes almost 2 years. There was a breakout attempt back in August of last year, but it failed. And so now it's going to attempt that again. I think this time, if it is successful, this is not going to matter at all. And I think you could see this move higher and go to this new congestion level that goes all the way back to 2016 level. That congestion level is between 155 and 161. So a move from now, from 150, if you're asking me what my target is, if it breaks out here, I expect minimum this to go to 155, which is pretty significant, almost 10% move. And I think you could see this thing pause then between 155 and 161. So somewhere around here would be my target. And I like buying June call options in this one. So that's a technical view. Now on the option side of the thing, something very fascinating, something very interesting option activity that has been popping up on my screen for last couple of days. And I mentioned this frequently that I often, and I mean I'm doing this for so many years. It is many traders tend to go after these big giant large block trades, institutional trades, because everybody gets their attention. But quite often it is this suspicious gradual out of money call accumulation, particularly in further out 3-4+ month out call options. Small amount of bites, taking place all the time, gradual accumulation where somebody is positioning but does not want to drive the price action too strong or does not want to get the attention necessary. That's the kind of suspicious action that I find most interesting when that happens. And that's exactly what we are seeing. Now, if you notice this June volume here, June 165, stock is trading at 141. If you focus on this June 165 call, well, now you guys are buying these call spreads, so some of this is you. But earlier today, there was a buyer of 300 contracts, straight calls of these June 165 calls. So let me show you what happened. Here is the snapshot. Let me see. Here you go. This is the picture from LiveVol. Okay. Here you go. See this? You guys have started buying at around 125. These are all of this action is you guys. All right. Well, at 125, just when we started presenting. But look at what happened at 12:49, about 11 minutes before I started the webinar. This was not me. Don't get your hopes up. Okay, I haven't even entered into the position yet, but there was a buyer of 300 of these June 165 calls for $3.70 on a bid and ask spread of 3 times 370. This was today, about 11 minutes before I started the webinar. But this wasn't the first time either. You notice that there is 760 open interest in these June 165 calls. Let me show you if I go back to yesterday. Let's go to March 5th. Let's go to Monday, 2 days ago. There you go. This was on Monday. About 7 minutes before the market closed, there was a buyer of 750 of these June 165 calls for 370 offer. Look at how big the bid and ask spreads was, 275 to 370, an aggressive bull. This was on Monday, 750. This is reflected in this open interest right here. Also notice in the June 160 calls, there's 400 open interest right over here, right? This was yesterday. If I go here and I select the strike, and you'll see it right here. There you go. This was yesterday, March 6th. In the morning, June 160 call buy. 300 of these contracts were bought for 470 above the offer when the bid and ask was 4 to 460. So Monday there was a call buyer. Tuesday there was a call buyer. Wednesday there was a call buyer. These are out of money, gradual, some very aggressive call accumulation targeting June 160 and 165 strike calls. If you do the math around it, about $400,000 to $500,000, almost $500,000 worth of call premium is accumulated in last 3 days in these two strike. And that's what gets my attention. There's something interesting going on over here, right? So you got the bullish option flow. By the way, this thing never appears on my radar. It never appears on my radar, rarely really gets attention. You can see that the open interest is very little all across the option chain. So this is quite unusual. So we got the technical side, we got the option activity side. Now on the fundamental side of the things. The company recently reported earnings. As you can see, the stock spiked right over here. And I went back and looked at that earnings report, and I saw some very interesting stuff. Okay, so here is the quick snapshot of things that stood out for me. You see, these are the kind of things that you can't see just when you pay attention to the headlines, you know, the EPS and the revenues, and whether it's telling you anything or not, because that's just headlines. You've got to dive deeper to find out. This is from a Street account, which summarized the earnings report very nicely, and it showed that the provider net adds. By the way, just so if you don't know, what is Athenaheath? Athenaheath basically is a company that tries to automate the medical practice for doctors and tries to save people money. It's a company that has for many, many years, it has created a whole host of software products and suites. It's a technology company that is targeting the healthcare sector. It has created a whole sort of, processes and softwares and suites and businesses that it tries to implement in the healthcare sector to try to save money for doctors and hospitals by automating their businesses. And so it's one of the biggest barometers, one of the biggest driver of the stock performance is not so much the revenue growth or the EPS growth. It is how much new, net adds, provider net adds is the company adding to its mix of businesses. That's because it becomes the threshold for future revenue expansion. So based on that, looking at the Q4 earnings report, this came out about a month ago. On February 2nd, you can see that the provider net adds was very strong. 4,166 versus consensus was 2,400 and change. Clinical ads was huge. Communicator ads was up. All three of them beat the consensus. Total revenues was 321 million versus 312 million. Implementation was slight miss, but it's okay. Service automation rate increased 68%. And the most important, this was one of the key reasons, and I'll dive more into this, why it's one of the most important reasons. The operating margin was 23.6% versus consensus of 14%. I mean, that's a huge beat. Why is this important, operating margin? Because go back, if you look at the history and you look at the earnings commentary from the management back in November, the company mentioned, the CEO mentioned, and by the way, the CEO he's been a funny guy. He talks funny. He has been on CNBC multiple times. He's the original founder and the CEO. And he was on CNBC and he was talking about this very thing. I look back at the history and he said that they expect the growth rate to remain year over year at high teens, right, 15 to 20% growth. But they expect now, after heavy investments that took place in the last couple of years to basically build out the software suites and platform, now they expect the scale to benefit from the scale. As new ads, provider nets come in, and as a result, they will see that the fixed cost portion of the business will become less and less of the equation, and the variable cost of the equation will become more and more, and as a result, net operating margins should get a boost higher. Well, boom, right there. This operating margin, this is exactly what happened. He was right on the money as they expected, and now we're seeing operating margin increase. This earnings came out on February 2nd, right here, right? 2 weeks after that, on February 15, company held its analyst day. I went back to the website and I basically pulled the entire analyst day presentation from the management, which is right here. A lot of things were discussed in this management presentation. This was on February 15. But I'm going to skip through this entire thing because there are 2 slides in this that talk about the very margin, okay, the improvement in the margins. And those 2 slides are right here. You can see this is the first slide that got my attention over here. You can see how strong the 2018 guidance is, but more importantly, it's the operating income and the operating margin that is accelerating sharply. The revenue growth is steadily continuing. but the operating income is going to double, which is a sharp acceleration. I mean, that it doubled in 2017, and once again, it's going to be 2018. So these last, you can see that how this gray area operating income had no leverage, because this is where they were building out their suites for many, many, many years. They wanted to have the right product in the marketplace to basically save doctors and hospitals money by trying to automate their businesses. So for a long time, while the revenue was steadily rising, but they didn't have the operating leverage. That has started to change in the last 2 years, and you saw evidence of that in the last quarter. I think this is a hugely positive argument that I believe it's not baked into consensus view. And the fact the company posted 23.6% margin when the consensus was 14%, that alone is telling me that it was not baked into consensus view then on February 2nd, and it's not baked into consensus view now either. The company mentioned this was directly from their analyst day that they had on February 15th. Along the same lines, here's a second chart, and this one talks about the same thing. Notice right here, 2016, the operating margin was 2.5%. I mean, if you go back to 2015, it was 0.4% negative. Then jump to 2.5%, 2017, 5.8, and now look at the range they are providing for 2018. This is the GAAP operating margin, which most people don't care about because it's got all kinds of non-cash operating things that are included in this. So most people use, non-GAAP operating measures, and you can see the same results over here. Operating margins is improving because they're getting a very nice, economies of scale after building out the products and suites for many, many years. And that has now come to completion, and now it's time to basically bank the money by trying to sell those to providers. So I really like the story over here about the margins, and I don't think it's fully baked into it. I also like the fact that the company is going to consistently still perform better on the revenue lines in the high teens. And so you got those two factors on the fundamental side of the things. You got the technical that is setting up for a breakout, and you got the option activity, very unusual option activity that is gradually accumulating in these June 160 and 165 strike calls. So got all those three ingredients, go for it.